Welcome to ZZ Financial. We're committed to providing the most accurate, valuable, and timely insights and analysis.
And welcome, everyone, to this deep dive. It is Wednesday, August 13th, 2025. For those of you on the U.S. East Coast, we're heading into the evening about 9 p.m. And out on the West Coast, it's late afternoon, around 6 p.m. We're here today because, honestly, it's been a really fascinating day in the financial world. It feels like there's been this huge shift, and it seems like it's mostly driven by one really powerful force. And the ripples from that, they've touched pretty much every corner of the global market.
That's exactly right. What we're seeing here is it's a classic interplay, really.
Yeah.
You've got market sentiment, these direct signals from, well, very influential figures, and then the underlying economic data itself. It's all sort of converging to create this really dynamic picture.
Okay.
So our goal for you today is to connect these dots. They might seem separate at first glance, but we want to help you understand not just what happened today, but why it happened the way it did. What are the sort of bigger picture implications? And maybe most importantly, how these kinds of shifts might, shape the financial world you're navigating every day.
So peeling back the layers, basically.
Right. Exactly. Getting beyond the headlines to see what's really driving things.
Okay, so let's really unpack this central theme then, because it does feel like the absolute center of gravity for everything that happened today, from New York trading floors to Tokyo, everywhere. It all seems to circle back to this one huge question. What is the Federal Reserve going to do with interest rates? What's the very latest piece of news that got everyone so, reactive?
You've hit the nail on the head. That's the epicenter. The biggest catalyst for today's market moves came from the U.S. Consumer Price Index, it's CPI data for July.
Okay, the inflation number.
Right. And this report, it actually came in below what the market was expecting. It showed a year-on-year increase of 2.7%.
2.7%.
Yep. And, to give you some context, that figure was pretty much exactly what investors were hoping to see. It really eased those worries about inflation suddenly accelerating again.
Ah, okay. So relief.
Big relief.
Yeah.
It was basically the green light, the trigger for a whole wave of bets that rate cuts are coming. But it wasn't just the data that moved the needle so much. We also got some, extraordinarily direct and specific comments from the U.S. Treasury Secretary, Secretary Besant.
Oh, direct. How direct?
Very direct. In an interview, she really didn't mince words. She stated quite explicitly, actually, that policy rates should probably be at a lower level of 1.5, 1.75%.
Wow, that's specific.
It is. And then she went even further. She directly suggested a 0.5% rate cut in September. And not just a cut, but as the actual start of a whole series of reductions.
A 0.5% cut in September has the beginning.
That's what she suggested. Now, you really have to appreciate the weight of a statement like that. For a U.S. Treasury Secretary to make such a precise, forward-looking comment about Fed policy.
Yeah, isn't the Fed supposed to be independent?
Exactly. It's highly unusual, and it carries immense influence, regardless of the independence aspect. It wasn't some subtle hint, you know. It was loud and clear this is the administration's thinking, and the market. It absolutely absorbed every single word.
Okay, wow. So incredibly direct signal there. How fast did the market actually react to something that specific? Do they just immediately price all this in? And what does that FedWatch tool actually show us? Like, how convinced is the market about a September cut now?
Oh, it was virtually instantaneous. The market uses tools like FedWatch, which basically looks at interest rate futures to figure out the implied probabilities.
Right.
And it reflected this conviction almost immediately. We saw basically a near 100% probability priced in for some kind of September rate cut.
100%.
Pretty much. To be specific, it was showing a 93.8% chance for a standard quarter-point cut.
Okay.
And this is the real surprise, a 6.2% chance for that more aggressive half-point cut that Besant mentioned.
Huh. So even pricing in a small chance of the bigger cut.
Exactly. And for the market to show that level of certainty, more than a month before the actual FOMC meeting, that's really exceptional.
Yeah, that seems unusual.
It really is. It tells you just how strong the market's collective belief is right now. They think this easing cycle isn't just probable, it's imminent. And maybe even, quite substantial. It's fascinating, really, how quickly that one piece of data, amplified by that very powerful political statement, created such a strong consensus.
Okay, so here's where it gets really interesting for me. You've got these super strong rate cut expectations. The market's basically guaranteeing a cut in September. And we saw U.S. stocks just skyrocket to new records today. But doesn't that kind of like wild optimism usually come with some warning signs? Isn't there usually a fear index that signals maybe things are getting overheated or at least shows some healthy caution? It almost feels, I don't know, a bit too good to be true. If I were listening, I'd be thinking, is this the calm before a potential storm?
You've put your finger right on the paradox. It absolutely feels that way, and that's exactly where this cognitive dissonance in the market really shows up. We certainly saw a huge surge in U.S. stocks. The Dow Jones Industrial Average, for instance, it jumped over 460 points, closed up near 44,922.
Wow.
Yeah, getting incredibly close to its all-time peak from back in December. And both the S&P 500 and the NASDAQ hit fresh record highs again. That's 2 days in a row.
2 days of records. Okay.
And it wasn't just a few stocks. We saw big gains across different sectors. Leaders like United Health, IBM, Nike, Sherwin-Williams, they were all acting as these powerful engines pushing the indexes higher.
Yeah.
It was a broad rally, really fueled by this sense of relief and optimism.
Okay, but what about that fear index? The VIX?
Yes. Your question about the fear index is spot on. The VIX index, which everyone calls the fear index because it measures expected stock market volatility,
Right.
it actually dropped. It fell to an 8-month low today, around 14.73. At one point, it even touched 14.38, which is an astonishing 25-year low.
A 25-year low in the fear index, while stocks are at records.
Exactly. It signals an almost, unnervingly subdued level of market anxiety. Now, on the surface, that sounds great, right? Less fear, more confidence.
Seems good, yeah.
But this is where that cognitive dissonance really bites. There was a recent Bank of America survey, and it revealed that a staggering 91% of institutional investors, the big players, the professionals,
81%.
91% of them think U.S. stocks are overvalued right now. And on top of that, 41% think we're actually in an AI bubble.
Okay, wait. So the pros think stocks are overpriced and there's an AI bubble, but the fear index is at a 25-year low and everyone's buying. How does that work?
That's the million-dollar question, isn't it? It seems investors are actively buying into a market that the vast majority of the smart money openly says is too expensive. Why?
Yeah, why?
Well, often it's driven by a powerful psychological force. FOMO, the fear of missing out. Nobody wants to be the one sitting on the sidelines while everyone else seems to be making easy money.
Right, you don't want to miss the rally.
Exactly. And it's also fueled by something called the greater fool theory.
The why?
The greater fool theory. It's the idea that you can buy an asset that you know is already overvalued because you believe there will always be an even greater fool out there willing to buy it from you at an even higher price later on.
Huh. That sounds risky.
It is. And for you, the listener, this is a really critical point. The risk isn't just in the numbers, the valuations themselves. It's also in this collective psychology where sentiment, maybe not fundamentals, is pushing prices into potentially unsustainable territory. It's like a high-stakes game of musical chairs or hot potato.
That's a fascinating way to put it, and frankly, a bit unsettling. Like, everyone's at this big party, they know the punch might be spiked, but the music's so good they just keep dancing anyway.
That's a pretty good analogy, actually.
So how did this optimism, or maybe this collective leap of faith, spill over into other big markets like bonds and currencies? Because if rates are expected to go down, that usually shakes things up everywhere, right?
Precisely. The impact wasn't just in stocks. It definitely reverberated across global finance. Take the bond market. We saw a significant reversal there from recent trends. U.S. long-term interest rates fell quite sharply. The benchmark 10-year Treasury yield, for example, dropped down to 4.23%.
Okay, so yields down. Why?
Because investors started piling into bonds. They anticipate that lower future rates from the Fed will make these existing bonds, with their fixed payments, more attractive down the line.
Got it.
And this easing of bond yields, in turn, actually helps stock valuations too. It makes future corporate earnings seem more valuable when you discount them back to the present.
Okay, so lower bond yields help stocks. Was this just a U.S. thing?
No, not at all. It wasn't confined to the European government bonds followed right along. German 10-year yields fell to 2.6%. UK 10-year yields dropped to 4.5%. It was like a global move into bonds, reflecting the synchronized expectations of rate cuts, particularly led by the Fed. And then, as you'd expect, we saw quite a bit of turmoil in the currency markets. This is a direct consequence of those shifting rate expectations.
Okay, what happened with the dollar?
The dollar weakened. Pretty broadly, actually, against most other major currencies. The euro, for instance, gained against the dollar, hitting a 2-week high around 1.1790 to 1.1720.
Okay.
The British pound also rallied, hitting a 3-week high against the dollar, trading up around 1.3550 to 1.3560.
And the logic there is just lower U.S. rates make the dollar less attractive.
Exactly. If U.S. interest rates are expected to fall, holding dollar assets becomes relatively less appealing compared to holding assets in currencies where rates might stay the same or even go up.
Mhm.
Simple as that. What was particularly interesting, though, was the Japanese yen. It strengthened quite substantially.
The yen got stronger against the dollar.
Significantly stronger against the dollar, yeah. It moved into the mid-147 range, around 147 yen to 147.60. And it even gained against the euro, reaching about 172.40 to 172.50.
Why would the yen strengthen so much? Japan's rates are still super low, aren't they?
They are, but it's all about the differential. The interest rate gap between the U.S. and Japan. Historically, holding yen wasn't very attractive because you earned almost nothing, while U.S. rates were higher.
Right, the carry trade.
Exactly. But now, if U.S. rates are expected to fall, while Japan's rates might stay put, or as we'll discuss later, maybe even rise a tiny bit, that differential narrows.
Okay. Makes the yen relatively more appealing.
Precisely. It becomes more attractive for investment flows and less attractive to borrow yen to invest elsewhere. So
Yeah.
it's almost like this giant global repricing of money flows, all kicked off by those U.S. rate cut expectations. What's really quite striking here is just how quickly and how comprehensively these U.S. rate cut bets got priced in across the board. It created this massive domino effect.
Yeah.
It's almost like the markets collectively just said, okay,
Yeah.
we've been waiting for this signal, now let's move.
Yeah.
But as you pointed out, that underlying investor psychology with those warnings about overvaluation and the VIX hitting rock bottom, it definitely suggests there's a deeper, maybe more uneasy dynamic happening beneath the surface. It feels like a market running on hope, but with a lot of caution flags being waved by the pros.
Okay, so this global story, especially the U.S. rate situation, it sounds huge, immense. But what does all this actually mean for Japan specifically? Because while the U.S. markets were hitting records, we also saw some pretty incredible, maybe even confusing moves in Japanese stocks. They seem to be almost marching to their own beat in some ways. What's the story unfolding there today?
Japan's market story today is equally compelling, absolutely. And it definitely has its own unique flavor, even with this strong global tide. The Nikkei 225, Japan's main stock index, hit a historic milestone today.
Yeah. What happened?
It actually surpassed 43,000 yen for the very first time ever.
Wow, 43,000.
Yep. This came after a really impressive six-day rally. They're hitting all-time highs. And we saw big gains across the board. Major companies like Sony Group, Mitsubishi UFJ Financial Group, they hit their own record highs too. It really shows broad, accelerating confidence in the Japanese market right now. Now, what's genuinely surprising, and maybe a bit unusual, is a noticeable shift in how Japanese retail investors are behaving.
The individual investors, how so?
Well, traditionally, these investors in Japan are often seen as contrarian. They tend to sell when the market hits peaks, lock in their profits. They often step back when they feel things are getting overheated.
Okay, sell high. Makes sense.
Right. But this time, many of them seem to be adopting what's called a momentum strategy. Basically, they're buying into the rally, even though there are, arguably, signs of overheating already.
So they're chasing the gains instead of taking profits.
Exactly. There was even this anecdote mentioned about, I think, a 50-something retail investor buying stocks like, Dishes the food company, even during the Obon holiday week, which is usually a really quiet time for trading in Japan.
Oh.
It points to this real shift in market psychology, almost like the feeling is, hey, if it's going up, I need to get in now, regardless.
That's quite a change. It sounds like that fear of missing out, FOMO, isn't just a U.S. thing anymore. It's global.
It certainly seems that way.
And if the individual investors are piling in like that, what does that tell us about the overall mood? Are people betting against this rally at all, or is everyone just bullish?
That's a great point. And yeah, FOMO does seem to be a powerful global driver right now. And this optimism among retail investors, it's also clearly showing up in the declining popularity of bearish ETFs.
The funds that bet on the market going down.
Exactly. For instance, there's one called the NXT FNDS, Nikkei 225 Double Inverse Index ETF. It's designed to profit when the Nikkei falls. Well, the number of outstanding units in that fund dropped by about 10% just since late July.
Okay, so fewer people are betting against the market.
Significantly fewer. It indicates a clear reduction in bearish bets and a strong shift towards a more bullish outlook. It's a pretty strong signal that most participants are firmly on the buy side of the equation right now. Interestingly, A lot of seasoned analysts are drawing parallels between this current Japanese bull run and the one back in 2013.
Oh, yeah. How so?
Well, that rally back then was also fueled by strong buying from foreign investors and a lot of companies buying back their own shares. And crucially, it also tended to ignore many of the typical warning signs of overvaluation, much like we're seeing today.
Huh. History repeating.
Possibly. The current gains are very broad-based, too, hitting large-cap stocks, small-cap stocks, everything. That suggests this uptrend in Japan could actually be quite prolonged, maybe running longer than many people initially thought. It feels like the market has found a real conviction supported by several different factors.
Okay, this all sounds incredibly positive for Japan hitting record highs. But, if it's drawing comparisons to past bull runs and there's all this optimism, especially from retail, surely there have to be some signs it's getting overheated, right? Like, as a listener, I'm always told what goes up must come down. What are the technical indicators actually saying? Are there any potential blind spots in this apparently unstoppable rally?
You are absolutely right to ask that critical question, because while the euphoria is definitely there are indeed clear, flashing warning signs of overheating. We absolutely need to look at those closely.
Okay, like what?
Well, for instance, look at the Nikkei's deviation from its 25-day moving average. It reached 6.5% upwards.
6.5% above average.
Right. And typically anything over 5% is considered overbought, suggesting the market might be stretched, maybe due for a pullback.
Okay, that's one sign.
Another one is the advanced decline ratio. This basically compares the number of stocks rising versus falling. That ratio soared to 155%.
155.
Yeah. The usual overbought threshold for that is around 120%. So 155% is well above that, indicating a very broad, perhaps unsustainably broad rally.
Got it. So multiple technicals flashing red.
Flashing warnings, yes. And historically, the Nikkei index tends to reach a peak when its forward price-to-earnings ratio, the PE ratio,
Right, valuation.
hits around 17 times earnings. Based on current earnings forecasts, this suggests the current level might very well be a temporary ceiling, a point where the market could become quite vulnerable to a correction. What's more, some market watchers are even calling this rally the reverse Trump shock.
Reverse Trump shock? What does that mean?
It implies the rally is mainly driven by relief specifically. Receding worries about potential tariffs if Trump were to return, rather than purely based on fundamental economic strength in Japan.
Ah, okay. So more speculative.
That's the argument. It makes it feel more like a speculative-driven rally.
Mm-hmm.
And we're seeing this rally expand now, even into lagging small and mid-cap stocks. That often happens in the later stages of a bull market, and it starts to resemble what some analysts are calling an uncertainty bubble.
An uncertainty bubble.
Yeah, the idea is that in an uncertain world, maybe with high interest rates elsewhere, money just flows into stocks, not necessarily because they're cheap fundamentally, but simply because people are chasing quick returns. It's a hunt for yield, a search for any positive return wherever it might be found.
Okay, that makes sense. People just want growth somewhere.
Exactly. And we also need to look at some classic signs of past bubbles, things like turnover ratios and margin debt. The U.S. stock market's turnover ratio, that's the annual trading volume, compared to the total market value, it surged to 3.0 times by June. Historically, when that ratio gets above 3.0, it has often come before significant market corrections.
3 times the market cap traded in a year. Wow.
It's high. Tokyo's turnover ratio also rose, hitting 1.46 times. And then there's the sheer amount of borrowing to buy stocks' margin debt. U.S. margin debt hit a record $1.079 trillion in June.
Over $1 trillion borrowed to buy stocks.
Yes, and for you, the listener, these aren't just abstract figures. They point to a really high level of speculative activity and a lot of leverage in the system. It means investors are borrowing heavily, which magnifies potential gains, but crucially also magnifies potential losses. This kind of aggressive borrowing often precedes more volatile periods. And this leads us straight to this idea of income effects and the risks involved.
Income effects.
Yeah. See, when interest rates are relatively high and stocks are performing well, it can really boost household financial income. The money people get from bond interest, stock dividends, maybe real estate income. Okay. In the U.S. alone, this household financial income hit $7.3 trillion in 2024. That's more than double what it was back in 2009.
Wow, that's a huge increase. Sounds good for the economy, right?
On the surface, yes, it sounds wonderfully positive. More income supports consumer spending. However, these rapid rallies, especially when technical indicators are flashing warnings like we discussed, carry big risks. Current PE ratios, the yield gaps between stocks and bonds, you're signaling historic overvaluation. And here's the real paradox. If this uncertainty bubble is partly fueled by people chasing yield because interest rates are high elsewhere,
Right.
then counterintuitively, the Federal Reserve actually cutting rates, which, remember, often happens when they see economic weakness or recession looming, that could be the very thing that bursts the bubble.
Wait, so the rate cuts everyone wants could actually pop the bubble? How?
Because those cuts could trigger what we call reverse income effects, that
Yep.
stream of income from bond interest and maybe even dividends that has been boosting household wealth and spending. It could suddenly contract sharply if rates fall significantly.
Ah, so the income boost disappears.
Exactly. Think of it like the financial tide suddenly going out very quickly. It could mirror the kind of sudden, severe corrections we saw in past crashes, like the dot-com bust or the Lehman shock. So for you, the listener, this is a critical warning. What looks like a positive adjustment, lower rates, could actually become a major drag on personal finances and investments if it coincides with bursting an overvalued market. It's a very, very delicate balance, maybe even dangerous.
That's a really profound thought that the very thing the market seems to be celebrating, lower rates, could actually be the trigger for a downturn.
Wow. So, okay, if the U.S. is looking at rate cuts, but Japan is showing these signs of overheating, how does all this global rate talk, especially those direct comments from the U.S., actually affect the Bank of Japan and Japan's own bond market? It sounds like they're caught in a bit of a tug of war.
You've described it perfectly. It really is a tug of war for the Bank of Japan, the BOJ. While those U.S. rate cut expectations are generally pushing global bond yields down,
Japan's bond market is dealing with a more nuanced, almost contradictory situation. There are actually growing expectations within Japan that the BOJ will resume raising interest rates, maybe even within the year.
really? While the Fed cuts, the BOJ might hike.
That's the expectation building. For example, the main opinions released from their July policy meeting minutes. They included views that the BOJ's current wait-and-see mode could be lifted as early as within the year.
Okay, so hinting at hikes.
The market definitely took it that way as
Okay.
quite hawkish, leaning towards tightening policy. So this underlying expectation of a BOJ hike puts upward pressure on Japanese bond yields. It's directly opposing the downward pressure coming from the U.S. easing expectations.
Okay, tug of war. Got it.
And we saw direct evidence of this conflict in a recent auction for 5-year Japanese government bonds. The results were described as weak.
Weak demand.
Yeah, the bid-to-cover ratio, which basically measures how much demand there was relative to the amount of bonds offered. It hit 2.96 times. That's the lowest level for that auction since March 2020.
So investors weren't eager to buy. Why not?
Because they're anticipating that if the BOJ does raise rates later this year, the price of these existing bonds will fall. So they're holding back, demanding a higher yield now to compensate for that future risk. It clearly shows investors are cautious because of these potential BOJ policy shifts.
Makes sense. But then you mentioned the U.S. influence.
Right. And here's where global politics really tangles with monetary policy. What's truly remarkable is the direct, open pressure coming from U.S. Treasury Secretary Besant on the BOJ.
She commented on the BOJ, too.
She did. She publicly stated her view, and she was very careful to say it was her view, not BOJ Governor Ueda's view, that they, the BOJ, are behind the curve and will likely raise rates to control inflation.
Wow. The U.S. Treasury Secretary telling the Bank of Japan they need to raise rates?
Pretty much.
Yeah.
It's a profoundly significant political statement. It's essentially the U.S. Treasury actively encouraging, maybe even pressuring, the BOJ to tighten its policy.
What's the effect of that?
Well, comments like that from a U.S. Treasury Secretary can definitely influence market expectations about the BOJ's future actions. And it also tends to support buying the yen, because a tighter BOJ policy would narrow that interest rate gap with the U.S., making the yen more attractive. Interestingly, this expectation of BOJ rate hikes, even as the Fed looks to cut, is actually helping Japanese bank stocks.
Helping banks? How?
Well, generally, higher interest rates mean better profit margins for banks. They can earn more on the loans they make. So, for example, Mitsubishi UFJ Financial Group, MUFG, it saw an initial dip maybe from profit-taking, but it quickly bounced back.
Ah, because higher rates are good for their business.
Exactly. So while U.S. rate cuts are boosting global stocks overall, the anticipation of BOJ rate hikes is creating this distinct and quite positive dynamic specifically for Japan's financial sector. It's a really complex interplay between global easing currents and domestic tightening expectations.
That is a truly intricate dance, isn't it, between the global forces and the local ones. Makes you realize every market really does have its own personality. But okay, let's shift gears a bit. Beyond these huge market trends and the central bank moves, we also saw some really fascinating individual company stories today. Stories that highlight strategic changes, how companies react to market forces, even the future direction of whole industries. What really stood out to you in the corporate world today?
Oh, absolutely. There are some really compelling stories unfolding at the company level,
Yeah.
showing how businesses are adapting to all these broader currents. Let's start with a kind of unique one. Orion Beer.
Orion Beer from Okinawa, right?
That's the one. They just submitted their application to list on the Tokyo Stock Exchange. They're hoping to go public as early as September.
Oh, wow.
Yeah, and if they do, they'd actually be Okinawa's first listed manufacturer. So a pretty big local milestone. What's really remarkable, though, is their recent turnaround.
They struggled during the pandemic.
They did. Hit hard by the loss of tourism. But they've bounced back incredibly well, largely thanks to tourism roaring back. They reported record revenue, $27.8 billion, for the year ending March 2025, and their profit was up 3%.
Nice rebound.
Yeah, and they're making smart strategic moves too, like partnering with that new Jungly Okinawa theme park. And they sold a hotel in Naha to focus more resources on developing resorts. It's a classic case of a company pivoting, leveraging new market conditions and sharpening its focus. Then, switching gears completely, we have a very different kind of story with Trial Holdings. They're a retail chain.
Okay. What's happening with them?
They're dealing with some pretty significant acquisition headaches. They're forecasting a mass 96% plummet in their net profit for fiscal year 2026, down to just $500 million.
96% drop. Why?
It's due to huge M&A-related costs, about $25 billion, coming from their acquisition of Seiyu, another big retail chain in Japan.
Ah, the cost of buying another company.
Exactly. Now, despite this immediate hit to profit, integrating Seiyu is expected to boost Trial's overall sales by a massive 65%, pushing them over $1.3 trillion in revenue for the first time.
Okay, so huge sales growth, but profit gets crushed short term.
Right. Their plan is to use Seiyu's store network to open new Supercenter and Trial Go format stores. And long term, they expect procurement synergies, basically, saving money by buying goods in larger volumes together.
Makes sense strategically.
It does, but for investors right now, that huge short-term profit hit is definitely weighing on the stock price. It dropped today. It's that classic tension, long-term strategic goals versus immediate financial pain.
Yeah, a company taking a big, potentially expensive bite, hoping it pays off down the road. Okay. Speaking of big investments, the AI sector is always a hot topic. We hear constantly about massive spending there. What's the latest buzz in that space? Are all the AI companies just soaring, or is it more complicated than that?
Oh, the AI sector is definitely a roller coaster, as always.
Yeah.
And it's absolutely more complex than just everything going straight up. We saw CoreWeave today, for example. They're a big AI cloud provider.
Okay.
Their stock plunged almost 20%, 19.7% down.
Wow, nearly 20%
And they're
more.
actually linked to a wider net loss than expected. And that loss was driven by surging costs, specifically capital expenditures related to building out their AI infrastructure.
So they're spending a ton on AI, and it's hitting profits now.
Exactly. Even though their revenue was growing strongly, the sheer cost of investing in all the servers and technology needed for AI can really impact profitability right away. It's a good reminder that not all growth comes cheap, especially in AI right now. On the flip side, you have a company like Cisco Systems, the networking giant. Their stock had kind of mixed trading today, but they reported incredibly strong orders for AI infrastructure, actually more than doubling their initial targets.
Doubling targets for AI gear.
Yeah, so that signals really significant long-term growth opportunities for Cisco as they provide the essential plumbing for AI, the backbone. It shows that while some companies might struggle with the immediate costs, others are thriving by selling the picks and shovels for the AI gold rush.
Okay, so winners and losers, or at least different timings.
Definitely different timings and high volatility. Look at Coherent. They make optical components, vital stuff for data centers. Their stock plummeted 18% today.
18%? What happened there?
They missed their revenue forecast.
Yeah.
Even though their Q2 earnings were actually strong, also driven by AI demand, it just shows how incredibly high the expectations are in the AI space right now. Even a small miss on forecast can lead to a massive sell-off.
Got it. High expectations, high volatility.
Exactly. And C3.ai, another well-known AI software company,
Yeah.
they also saw a huge dip down over 25% today on disappointing preliminary earnings results. So again, it proves that not every AI stock is immune to market reality checks. Now, looking at strategy, there are reports that Apple is planning to launch new AI-powered devices.
Oh, yeah. Like what?
Things like a tabletop robot for 2027. designed to be a sort of virtual companion,
Hmm.
and maybe a smart speaker with a display coming next year.
A robot from Apple. Interesting.
Yeah, these are ambitious moves, apparently aimed at helping Apple regain momentum in the generative AI race, where some people feel they've kind of lagged behind competitors recently. And just to show the diversity out there, completely different stories. Santario, the Hello Kitty company, they actually led trading volume in Tokyo today.
Hello, Kitty. Why?
Strong interest from foreign investors, apparently focused on their growth potential and upwardly revised earnings forecasts, especially driven by their licensing business in China.
Oh, okay.
And Nexon, the big gaming company. Their stock hit a year-to-date high today. They reported a 7% rise in operating profit and announced a 25 billion yen share buyback program, mostly thanks to the strong performance of their big PC game, MapleStory.
Wow. So really, from AI hardware costs to Hello Kitty licensing to online games, it's a very diverse corporate landscape responding to everything.
Absolutely. It paints a really vivid picture of adaptation, strategic moves, and just very different reactions to all the market forces we've been talking about.
Okay, so it's definitely a mixed bag in the corporate world. Some are investing heavily and feeling the pain short term. Others are riding specific waves, even traditional companies finding new ways to grow. What about beyond the tech world and these big corporate maneuvers? It seems like even everyday items, retail giants, they're feeling the heat too, right? From new competition or maybe broader economic shifts. What's happening on that front?
Absolutely. Those ripple effects we talked about, they definitely extend right down to the things we buy every day and the companies that sell them. Take Walmart, for instance.
Okay.
Their shares fell over 2.5% today, and that followed Amazon's announcement that they're rolling out same-day grocery delivery more widely.
Amazon competing harder on groceries.
Exactly. That move instantly intensifies the competition in the retail grocery space, and it sparked immediate concerns for established players like Walmart.
Makes sense. What else?
Well, Kava Group, they're a popular fast casual Mediterranean restaurant chain. Their stock plunged over 22% today.
22%. Why?
They lowered their forecast for same-store sales growth, that's a key metric for restaurants, and lowering it signals they expect a slowdown in customer spending in that part of the market.
Okay, so maybe consumers cutting back a bit on eating out.
Potentially, yeah. And Stratasys, they make 3D printers. Their stock dropped over 17%. They specifically cited macroeconomic uncertainty causing their customers to delay investments in new equipment.
Got it. So Walmart facing competition, Kava seeing slower sales, Stratasys seeing delayed business spending. It does paint a picture of broader caution, maybe.
I think that's fair to say. It reflects some of these underlying economic shifts and uncertainties playing out at the company level. We also saw some interesting moves in commodity prices. Crude oil, for example, continued to fall. The main U.S. contract, WTI for September delivery, dropped almost 1% to around $62.65 a barrel.
Oil prices still falling? Why is that?
Mostly due to rising U.S. oil inventories, more supply than expected, and also the International Energy Agency actually cut its forecast for oil demand growth in 2025. The supply looks ample. Demand may be softening a bit.
Good news for drivers, maybe?
Could be, yeah. Lower prices at the pump might be ahead. On the flip side, we saw the decline in international pulp prices, the raw material for paper, start to slow down.
Pulp prices stabilizing.
Seems like it. Major producers overseas, like Suzano in Brazil, announced they're cutting back production, about 3.5% in Suzano's case. That suggests supply might tighten, potentially leading to stable or maybe even slightly higher paper product prices down the road.
Okay. And what about gold, the safe haven?
Gold actually rebounded a bit today. December futures were up about 0.3%, trading around $3,408 per ounce.
Why the rebound?
Mostly boosted by those renewed hopes for Fed rate cuts and the weaker U.S. dollar. Lower rates and a weaker dollar typically make gold, which doesn't pay any interest, more attractive relative to other assets. And then maybe the most direct impact for your daily life, climate affecting food prices.
Oh, yeah.
Well, extreme heat and drought up in Hokkaido, which is a huge farming region in Japan.
Right.
It drove up the prices for everyday vegetables. Tomatoes were up 19%, carrots up 17%, just because the harvests were smaller due to the bad weather.
Wow, nearly 20% higher for tomatoes and carrots.
Yeah. But conversely, other regions had favorable weather, so prices for things like cabbage and lettuce actually went down. It just really highlights how immediate and localized the impact of climate events can be on the cost of basic groceries. And one last corporate point, highlighting supply chains. Mitsubishi Corporation announced a big investment, their first in a U.S. copper mine in 45 years.
Copper. Why now?
It's a major strategic move, about $87 billion. It signals a clear focus on restructuring their supply chains and securing critical minerals like copper which is essential for, EVs, renewable energy infrastructure, everything related to the green transition. It reflects this global push towards securing essential resources amid all the geopolitical uncertainty. It's a long-term strategic play, but with immediate implications for resource security.
This has definitely been a lot to take in. It's so clear how everything connects from, like you said, a Treasury Secretary's specific words all the way down to the price of a tomato. But beyond the sort of immediate numbers in the company news, there are always these deeper currents running underneath, right? Like political moves, shifts in global trade patterns, even the kind of looming question of who's going to be leading critical institutions in the future. What should we be thinking about on that broader, maybe almost hidden strategic level?
You're absolutely right. The financial world never operates in a vacuum.
Mhm.
It's deeply, deeply intertwined with politics, diplomacy, and potential shifts in leadership. Take Treasury Secretary Bessent's influence, for example. As we discussed, it goes way beyond just commenting on U.S. rates.
Sure.
Her very public statements, like basically nudging the Bank of Japan to tighten its policy.
Yeah, that was surprising.
It really showcases how political declarations from a major economic power can directly shape central bank expectations in currency markets worldwide. She's effectively using a diplomatic tool, almost, to influence monetary policy. That's a significant dynamic for investors to keep an eye on. Then there's that incredibly important, but maybe often overlooked, question of who leads the Federal Reserve next. The current chair's term is up in May 2026.
Right. Any news on that front?
Well, CNBC recently reported there are apparently 11 candidates being considered, and among them is Rick Ryder from BlackRock.
BlackRock. They manage huge amounts of money, right?
Massive amounts. Ryder himself oversees something like a $2.4 trillion bond portfolio, and importantly, he has openly expressed significant concerns about the sustainability of U.S. government debt.
Wait, so if someone who manages that much in bonds and someone who's already vocal about government debt, if he were to lead the Fed, what could that actually mean? You hear terms like bond vigilante sometimes. What does that kind of mindset mean, and why would it matter for, someone like me just trying to figure out my investments?
That's an excellent question, and it's absolutely crucial for listeners to understand. A bond vigilante mindset, essentially, refers to bond market investors who signal their displeasure with fiscal or monetary policies they see as irresponsible, maybe too inflationary, or leading to too much debt.
How do they signal displeasure?
By selling bonds. When they sell bonds aggressively, it pushes bond prices down and drives yields up. This makes borrowing more expensive for the government and for companies.
Okay, so they can kind of force discipline through the market.
That's the idea. Now, if someone with that kind of deep-seated concern about government debt were to actually lead the Federal Reserve, it could signal a potentially much more fiscally conservative approach to monetary policy.
What does that mean in practice? Higher rates?
It could mean the Fed might prioritize long-term fiscal stability and keeping inflation nailed down, perhaps even over maximizing short-term economic growth. That could potentially lead to interest rates staying higher for longer periods than maybe a more dovish or growth-focused Fed chair might allow.
Okay, so a very different approach.
A very different philosophical approach, yeah. It would certainly shift market expectations dramatically. Investors would have to rethink what kind of returns to expect. It would influence bond yields, corporate borrowing costs, stock valuations, everything. It could have really profound implications for everyone's investment portfolios and the cost of borrowing money, like for mortgages or car loans. Switching to geopolitics, we also have that highly anticipated meeting between Trump and Putin scheduled for August 15th up in Alaska.
Right. That's coming up soon. Why is that significant for markets?
Well, the outcome could directly impact things like U.S. tariffs on India, specifically related to India buying Russian oil. Depending on the discussions, broader sanction risks could easily emerge or recede. These high-level political meetings, which might seem distant from daily market moves, they can have direct and immediate consequences for global commodity markets like oil and overall trade flows. It just adds another layer of uncertainty that traders and investors have to constantly try and factor in. And finally, just briefly looking at China, we saw a really unusual signal there. Negative growth in new bank loans denominated in yuan for the month of July.
Negative loan growth, like banks lent out less than was repaid.
Exactly. Apparently, it's the first time that's happened in 20 years. It's a very significant economic signal, perhaps hinting at a slowdown or maybe shifts in credit policy within China's huge economy.
Okay, that sounds important to watch.
Definitely. And at the same time, Chinese authorities have reportedly been questioning major tech firms there like Tencent, ByteDance, about their use of certain AI chips from NVIDIA, specifically the H20 model.
Questioning them about chips, why?
Well, on the surface, it might look like a regulatory check. But some analysts think it could also be a subtle negotiation tactic in the ongoing tech and trade tensions with the U.S. Even discussions about specific chip usage can become part of that bigger geopolitical chess game. All these underlying currents, political appointments, diplomatic meetings, regulatory moves, subtle economic signals that are constantly shaping the landscape, often in ways that aren't immediately obvious from the daily headlines, but they have a profound influence on the future direction of markets and global stability.
Wow. What a truly comprehensive deep dive. Today, we've really navigated a fascinating landscape. We went from those massive ripple effects of the anticipated U.S. rate cuts all the way to the shifting psychology of investors over in Japan. Then we looked at the strategic moves by big corporations adapting to competition and tech shifts, and even these subtle but clearly powerful geopolitical undercurrents. It is absolutely clear, isn't it? Everything is interconnected. From, like you said, a Treasury Secretary's words to the price of tomatoes.
Indeed. And, in an environment like this, where market sentiment can swing so heavily based on a single political statement, where we see historic indicators of overheating being openly discussed, yet seemingly ignored by many market participants, it really challenges our conventional understanding of risk, doesn't it?
Really does.
You might find yourself asking, are we actually seeing some kind of fundamental new paradigm here, where maybe that greater fool theory really does hold sway for longer than we think? Or is the market just adapting in a way we haven't seen before to this unprecedented level of information and maybe external influence? Understanding these underlying behavioral drivers, the political influences, perhaps that becomes just as crucial, maybe even more crucial sometimes, than just dissecting the raw economic data itself. It's really about looking beyond the numbers to see the human and political forces that are shaping them.
That's a fantastic final thought, something for all of us to really mull over.
Thank you for joining us on this deep dive into today's most significant financial developments. We really encourage you to continue your own exploration of these vital topics, because understanding them truly empowers you in navigating the complex world of finance.